I am Maria Rosa Vaquerizo. I am the CEO of the Andean American Associations. And these were the very first chambers of commerce founded in the US for Colombia, Ecuador, Peru, and Venezuela. They were incorporated in New York City in the 1920s and 30s. Our chambers / associations have hosted more than 1,000 programs over the years. I want to give our partners of today a warm welcome for the seminar, the 10th Latin American Outlook 2023. Our partners of today are the Brazilian American Chamber of Commerce, the North American Chilean Chamber of Commerce, represented today by Manuelita Cori, and the US-Mexico Chamber of Commerce, represented today by Alejandro Ramos. Thank you very much for joining us. We are also very pleased and honored to have as speakers Alberto Bernal of XP Securities, Richard Francis of Fitch Ratings, and Benjamin Ramsey of JP Morgan. Our moderator is Kelly Librera of Winston & Strawn. Welcome all of you, and thank you so much for accepting this invitation. I would also like to welcome from our attendees, we'd like to welcome Juana Caicedo Selinger. She is the president of the Ecuadorian American Association, and Ambassador Michael Skoll, president of the Venezuelan American Association of the US, Christian Murle, our past president of the Colombian American Association. In addition, we have today Ambassador Maria Landeveri. She's the Consul General of Peru in New York. We also have a great pool of registrants, and I would like to say special regards to representatives of our Andean supporting members, BBVA and Hogan Lovells. We have also the multilateral agencies, the IADB and the World Bank. We have rating agencies, Fitch Ratings and SP Global. We have also with us today Nelson Baldion. He's a sponsor of the Ecuadorian American Association. And we have major banks, including Asobanca of Ecuador, Citi, Credit Suisse, Goldman Sachs, MUFG, Santander, UBS, and Wells Fargo. Corporations such as Glencore and Shell. Universities like American, Duke, UCLA, among others. And the media, we have Financial Times, represented by Michael Stott, Latin Finance, Voz Hispano News, and Jose Enrique Arrioja of Ziniox. Welcome to all the participants. So now we'd like to introduce our moderator. We have with us today Kelly Librera. She's a partner at Winston & Strawn LLP New York, and her practice focuses on complex commercial litigation. She has extensive experience representing insurance companies, financial services providers, and financial institutions in a host of complex disputes, civil and criminal investigation, class actions, and arbitrations. Kelly serves as a co-chair of the New York office's Associate Evaluation Committee. She's also a member of the firm's Complex Commercial Litigation Advisory Board, and she is a hiring committee member. It's important that, that you look at the bottom of the screen. You're going to have a Q&A button, and you can make questions during the presentation, and they will be answered to you later in the program. So Kelly will facilitate that. And now I give the floor to her so she can introduce our speakers. Thank you.
Thank you very much, Maria Rosa, and welcome all. We are very privileged today to have a distinguished panel to talk with us about developments in Latin America. Today we have with us Alberto Bernal, who is the Chief Emerging Markets and Global Strategist at XP Securities. Prior to that, he was the Head of Research and Partner at Boltic LLC and a Managing Director of Emerging Fixed Income Research at Bear Stearns. He's been responsible for covering Latin America and previously was head of the Latin America Economic Research Group at IDEA Global. We also have with us today Richard Francis, who is the co-head of the Americas team in the Sovereign Group at Fitch Ratings. He manages a group of sovereign analysts based in New York and spearheads the Sovereign Research Initiative in the Americas. He's also lead sovereign analyst covering the United States, Colombia, El Salvador, and Chile, among others. And we also have with us, last but not least, Mr. Ben Ramsey, who heads JP Morgan's Latin America Economics Research Team, and he manages regional economic products and he leads the team's economists. He's also the chief economist for the North Andean region. Ben also has covered sovereign credit events and restructurings in the Dominican Republic, in Ecuador, and in Venezuela. So without further ado, I'd like to turn the presentation over to them.
Thanks very much. Thanks to Maria Rosa, thanks to Kelly. A pleasure to be here with you this evening. Even more of a pleasure now that I've seen the result of the USA match where we've squeaked through and we will now advance. So that's good news. When we're thinking about this region, of course, we can't have our mind too far away from the World Cup when we, this time, well, not usually this time of year, but it is the time of year now. It's a real pleasure to be here. It's a really distinguished, I'm glad to be here with my friends, with Richard and Alberto, and such a distinguished group of guests who you've announced here with us today. I'll start by giving, basically an overview in terms of how we're seeing the economic outlook, and then I'll hand it over to Alberto to talk about the all-important political dynamics. Latin America has really, first of all, bounced back much more quickly from the pandemic than what we expected. Not to say that the growth results have been good. Latin America certainly, I think, had the hardest fall, both in terms of health results, but also in terms of activity in the initial stages of the pandemic in 2020. We were pretty pessimistic that the elements were going to be around for the region to bounce back the way it did. We were looking for something that was going to be much more gradual and something that was going to be, continue to put us in a world where some of the social pressure that we've seen in the region even prior to the pandemic was going to be brought more to bear again. And then the result, the region bounced back much more quickly than we expected in terms of getting sort of back to that initial pre-pandemic starting point, and in some countries approaching what was the path of economic activity, again, very low in the region, but back to sort of that pre-pandemic trend. We've been expecting this to sort of, run its course. We think that the region is, the drivers for growth ahead for the region are elusive. We've been expecting the region to sort of slip back into a sort of stall mode. And we've actually been surprised so far, as we've gone through 2023 and 2022, and obviously we're nearing the end of the year, but in terms of the data flow, getting through to the third quarter, that first half of the year was really much more resilient, particularly in the larger economies in Brazil and in Mexico than what our forecasts we're expecting. Again, we still are expecting the region to move, as I mentioned, back into something really below the low potential. Where for 2022, we're expecting 3.4% growth this year. That's considerably above what we were looking for at the start of the year. I think we do have to attribute, basically, again, in terms of this inertial rebound, which was faster than expected, the region was able to carve out much more space in terms of fiscal and monetary policy stimulus than we thought it had available to itself, as we started the pandemic. And I think that's really just reflecting just how strong and forceful the DM stimulus was in terms of the reaction, as we see, perhaps overly forceful, as we're now thinking about as we've gone through the course of this year, both in DM and in EM inflation concerns, which are still boiling. But that stimulus did calm markets, give much more space for historically low policy rates and much more fiscal stimulus than what we thought was going to be possible. And I think inertially that's been carrying through, as we've gone through this year. I'd say with an additional shock, which was all in all, by and large, favorable to the region, meaning the higher commodities prices, which came, had been recovering, but then had this extra boost after the Russian invasion of Ukraine. Of course, a two-edged sword when the region's dealing with inflation, but insofar as supporting external and fiscal accounts in the region, this gave us a positive shock. Now, we do think these drivers are going to be fading. tight and monetary policy, because inflation has been so high, and because regional central banks were conscious of not losing the credibility, the hard-earned credibility that they had managed to establish over decades of establishing inflation targeting regimes in the wake of experiences and by and large with hyperinflation. Central banks were moved early and moved high in the region. I think this was also important insofar as creating a sense of some stability. I think it helped us in terms of the region having, in a world where the dollar started to strengthen a lot in 2022, regional currencies, of course there was volatility, and some currencies suffered more than others, but generally speaking, currencies held in pretty well and by and large outperformed a number of emerging markets. But the region, getting to the head of the game in terms of tightening monetary policy and getting to restrictive levels, very high real rates compared to both DM and other EMs, helping credibility. But this is going to, bite into domestic demand as we go forward, alongside what we're expecting to be a lower impulse from external demand as the world is facing recession risks. And although commodities remain at generally supportive levels, they seem to be fading from very strong levels, which provide support to our region in terms of the very strong boost. Overall, I'd say also that we have, this is going to, eventually this will go towards Alberto's part of the discussion. I think we also have with a region which has seen government switch. We can call it anti-incumbency. We can call it the turn to the left. Whatever it is, it's created more left of center governments in our region than what we've had in the recent past, and it's created policy volatility and uncertainty, which I think, alongside higher risk premium in general, with the Fed having tightened and credit spreads going higher, this is limiting, I think, the confidence of domestic investors. So what we're seeing is, with governments being forced to basically pull back, that space where we might have the private sector stepping in seems more limited because of I think more, less clarity in terms of what is the path ahead on the policy front in a number of countries, and still, again, I think the concerns around inflation are also ones which we can't forget. Now, if we turn to our 2023 forecasts, we are expecting the growth in the region at the regional level to slow to 0.7% from that 3.4. So if potential in the region, which I think is a hard thing to measure as we've gone through the pandemic, is say roughly 2%, clearly coming from an above potential level to something which is going to be below potential. Again, part of this is by design. There's on the monetary policy side, restriction in order to try to fight inflation. And we think that the space ahead in terms of more fiscal policy, again, with borrowing costs higher, and fiscal rules also starting to impose themselves in a number of countries, is not going to provide space either in terms of additional impulse. So again, leaving that space for our private sector, which doesn't seem to be willing to step into it right now. We have recession calls, if we want to define that, as multiple quarters of quarter-on-quarter contraction in 3 countries ahead. Actually 4, if I want to include Argentina, which is a little bit in its own world, obviously, in terms of different dynamics and much stronger disequilibrium. But in Brazil, Colombia, Chile, and also Argentina, we have in the coming quarters multiple quarters of contraction, so outright recessions. And we think that overall, we have more. We think we've got more downside risks in terms of our growth forecasts than upside risk. And I'd say, particularly there, we would highlight Colombia, which seems to be perhaps at a risk of a sudden stop dynamic, given the very large current account deficit, which is alongside its fiscal deficit. Mexico, for its part, has lagged the region overall in terms of coming back from the pandemic, so the rest of the region kind of caught up faster. Here, we do think that there's been some, let's say, opportunity cost, because with the U.S. growing so strongly, and with the world moving towards, basically the dynamic of separation between East and West, China and U.S., opportunities around nearshoring are real and are going to help Mexico, we think, over the medium term. But we haven't seen that, step in over a policy agenda, particularly based on, pointed towards a more nationalistic energy policy. and even some institutional backsliding, blurring rules of the road in Mexico. This has really hampered an investment dynamic, alongside basically lack of stimulus in the course of the pandemic, which really differentiated Mexico. Now Mexico, perhaps having missed the opportunity of very strong U.S. growth, now that we're basically highlighting strong risks of U.S. recession by the end of 2023 in our forecast at JP Morgan, that's going to be a real headwind, as we know that the linkages between the U.S. and the Mexican economy, although maybe not fully captured on the way up, are not going to be in our minds, something Mexico can avoid on the way down if the U.S. does head into recession. So this is going to keep basically Mexican growth, which has been subdued, still a driver keeping it quite low. Now, we do think inflation is going to ease ahead, but we think core is going to prove more resistant than headline. We've seen labor markets in the region come back again alongside the economies come back better than what we had anticipated. But we do think that price formation channels here in the region have been rattled, as they have been everywhere else in the world. Again, as I mentioned, regional currencies have generally held in well, but the strong dollar dynamic still seems to be upon us. So there are FX pass-through pressures which are playing out in some cases stronger than others. And we're just not seeing, in terms of also a number of countries with indexation dynamics, but as inflation moves to higher levels than we've seen in decades, sort of starting to rear their head a bit again, also keeping inflation inertially high. We do think food and energy, as we're seeing in the world, will start to normalize. That will help headline inflation, but core inflation is going to be stickier. It's going to be harder to drive inflation back to target ranges. We generally think this is only going to be achieved by the tail end of 23 or into 24. Again, even though we've got a call of very low growth, and even though we've got the notion that central banks are going to be, which have achieved restrictive stances, are going to remain cautious and are not going to be looking, in our view, to cut policy rates too quickly, too fast. We don't see space for that, again, with inflation staying high. Now, we do think the central banks have largely finished their cycles. Brazil and Chile are apparently done at very high double-digit policy rates in both cases. We do think Colombia and Mexico have more to go, but we're also speaking about double-digit rates territories here. And Peru is also probably has a bit more to do. Inflation here is relatively better behaved. Overall, though, the view that we have on central banks, again, is although we think they can move lower, this is basically going to be following the path of inflation normalization, which should allow inflation expectations, which have become de-anchored, to start to move lower again. So if we think about policy rates, real policy rates, deflating inflation, and if we think about deflating forward-looking inflation rather than the observed backward-looking inflation that we're already seeing, but deflating policy rates by inflation expectations, as headline inflation starts to come down, we do think also those inflation expectations will start to come down. If central banks stay at these very high rates, effectively the real policy rates will be going higher. So we don't think that that's appropriate, and we think central banks will feel pressure in this environment, especially if we're right that the Fed will be pausing after it reaches a 5% Fed funds rate by the end of the first quarter in our forecast. That pause by the Fed and slower inflation will allow policy rates to move lower. But what we don't see, again, given the sort of inertially sticky nature of inflation, is that central banks are going to be able to get into easy territory. What we think they're basically going to be able to do is follow that path of lower inflation expectations, keeping policy rates either borderline restrictive, maybe getting down towards neutral territory, but we're not expecting easy monetary policy in the region in our forecast horizon. And with that, the other variable that we always have to think about when we're thinking about the regional outlook is politics. Never too far out of sight, never too far out of mind. As I mentioned, we do have a political cycle, which has, I think, contributed to political and policy uncertainty, which has been an impediment to more private investment. We can debate whether this is an outright shift to the left, or if this is just populations really struggling for something different, and at the end of the day, having an anti-incumbency bias. We don't have too many elections in the next year. We're really heading towards the end of next year with Argentina. Mexico by 2024. But with that, I think I'll hand it over to Alberto, who will delve into that very important component of Latin American outlook.
Thanks, Ben. Well, thanks, Maria Rosa, once again for inviting me. It's always a pleasure to be here, Alexandra, and to the Andean American Association. For me, it's an honor to always be here, and great to see my friends Rich, Ben, and very nice to meet you, Kelly, as well. So yeah, I mean, that's it's never boring on the political front in our region. Just as background, I was literally right before we started this call, I logged into YouTube and watched myself 1 year ago in terms of what I said in this exact event, and I actually said that Petro was not going to win. I said that the dollar would get weaker, and I failed to forecast that there would be a war in between Russia and Ukraine. So basically, all those things that completely changed our outlook when we had a very actually a much better outlook at this same time. I think it was the same week, if I'm not mistaken, Maria Rosa,
Yes.
1 year ago, and when we started talking about these issues. But still, and this is something that I'm actually quite impressed about, which is that the Nasdaq is down more than, I believe, something like 27% or 28% year to date. Brazil is up. The stock market in Brazil is up. The stock market in Mexico is up. If somebody bought a local Brazilian bond at the beginning of the year, a 10-year bond, and held to that exposure, that person is up 13.5% year to date on that very specific trade, compared to negative 30% if you had bought a 30-year bond in the United States. Which, by the way, for those of you that don't know this and you want to have a nice catchy thing to say on a dinner soon after that you will have on this year end, 2022 is going to be the worst year for the bond market since 1780. Let me repeat that. 2022 is going to be the worst year for the bond market since 1780. And I mentioned this because this is important, because if we had such a bad year in 2022, it's quite likely that we're going to have a rebound year in 2023. So for everybody that is in this call, probably 2022 is going to be the worst year that you had to live through in this life for the bond market, and 2023 may be actually the best year that you will see until God decides that we have to go someplace else. So it's important to keep that in mind. Now to the politics. Ben mentioned, I think that the most relevant elections are going to take place in Argentina. Argentina is an extremely relevant player for the world economy, especially on the commodities front, et cetera, et cetera. Argentina has the third largest reserves of lithium in the world. So it's a very important player. But as Rich knows, as Ben knows, as pretty much everybody that's on the call knows, not many people are too interested in the business and investment opportunities of Argentina right now, because Argentina has underperformed expectations for many years now. And unfortunately, the pandemic has not helped. And the level of macroeconomic disequilibrium that the country is living through right now is making Argentina pretty much an uninvestable place at this point in time. That's the reality. The good news is that the President Fernandez was able to get somebody like Massa to take over the finance ministry. Massa is a person that can deliver. He has a strong political background. He's adroit enough in the technical part of the job. So he has been able to stabilize the macro a little bit. And that's relatively positive news from the standpoint of Argentina crossing over to the election cycle, and hopefully at that point in time seeing a regime change. Because the most probable scenario is that we will also see a regime change in Argentina. And in the case of Argentina, it's not going to be a change from the right to the left, but rather from the left to the right. Because people are sick and tired of having to live with the Coldplay exchange rate, el cambio granos, dólar turista, dólar ahorro. I mean, you have like 50 different exchange rates, and it's just very, very complicated to have a life, to do business, and to save when you have so many different exchange rates. And this is all a function of the fact that Argentina continues to make the same mistakes that we thought we would be able to cure 30 years ago, because we have done this before. I mean, this is not the first time that a country tries a flexible exchange, like not a flexible exchange regime, but a multi-exchange rate regime type of situation. It just doesn't work because nobody knows what the real value of the peso is. And unless people know and investors know what the real value of the peso is, nobody's going to be willing to actually invest hard dollars into the country until we know the exact or the actual value of this currency. Unfortunately, I do think that it's almost an impossibility that before the election in 2023, we will see a decision, a very difficult political decision, but very accurate economic decision to let the currency find its actual value. Because the currency is not worth 160, as the government says, it's not worth 330, as the market thinks. 330, Argentina's per capita GDP would be lower than many countries in Africa, and we know that's not true. So the actual exchange rate is somewhere in between 160, 330. I have no clue which one that is. Maybe it's 210, maybe it's 220, but we need the market to let us know what that actual value is, if in order for the macroeconomic equilibrium to come back and be able to do some real business in Argentina. My sense is that this election is the opposition's to lose. If the opposition is unable to get some sort of cohesive coalition, then the Partido Justicialista could actually win. But my sense is that it's very unlikely that somebody from the hard left will be able to take over the presidency, because somebody from the hard left will not have the solutions to the most pressing problem that Argentina has right now, which is inflation. And if we know something from history, inflation tends to make voters vote to the right, not to the left, because inflation and left-wing governments tend to be kind of like together, lower inflation, adjustment programs, et cetera, more towards the right. So I still think that it's very likely that Argentina will once again, do the typical shift on the ideological front and go towards the center right in this election. And that should allow for 2024, perhaps 2025, to be actually pretty good years for investments in Argentina. Second in command, Mexico. We don't have elections in 2023, but the political environment is going to start heating up in 2023, and the Mexican elections of 2024 are of extreme importance. We still think that our political team here at XP sees very little probabilities of somebody from outside Morena taking over the government after López Obrador. Morena has a very powerful position right now. They are pretty entrenched in terms of the powers, and hopefully the political discussion will allow for Morena to become a little bit more center in terms of respecting institutions and sending messages of compliance with the established economic model, and no interest in further changing the economic model of the country, doing things that do not go in line with what Mexico needs to do to take advantage of this process of nearshoring or friendshoring that is happening at this point in time. I mean, it's pretty obvious to anybody that works in the market and knows anything about Latin America that the prime beneficiary of the problems that exist right now between China and the US is Mexico. And the only reason why Mexico is not seeing 60, 70, 80 billion dollars of FDI, additional FDI at this point in time, is because of the incapacity of the institutions to welcome that capital that is looking for a friendlier and closer place to do business vis-a-vis the United States. So hopefully, again, and this is, I'm an optimist by nature, so hopefully this will happen in the forthcoming years, and Mexico will get its act together to be able to welcome that new investment. 2023 will also be important for Colombia because we have regional elections. And I do think that in this case, the regional elections are going to be of extreme importance from the standpoint of the outlook of Colombia in terms of the economic model that the country will be able to implement going forward. Ben mentioned the stability of the external accounts. I am very concerned about the stability of Colombia's external accounts. I would not be if for some reason or if somebody were to be wise enough to sit down with President Petro and explain to him that stopping exploration of oil in Colombia makes absolutely no sense from the standpoint of saving the world from the climate catastrophe, because Colombia only produces 0.2% of all the CO2 that is produced every day in the world. So it doesn't matter what you do in Colombia. It doesn't matter if you take 100,000 barrels or 200,000 barrels of additional oil out of Colombia that will allow you to finance your current account deficit. It will allow you to finance additional homes for the poor and additional breakfast for the children that go hungry. But for some reason, this conversation is impossible to have with President Petro. But I'm an optimist, and I do think that at some point somebody or politics alone are going to force him to understand that it makes absolutely no sense to commit suicide for something completely ridiculous as to kill the source of FX for Colombia, which will allow for the currency to regain some value and for Colombia to avoid having to live through consecutive rating downgrades, which will happen, in my view, unless Petro changes his tune. And here, I think the 2023 elections become very relevant because the mayoral election in Medellin, the mayoral election in Bogota may make a big difference if and only if the center-right is able to somehow work itself into having some sort of primary or coalition, and in that way, be able to regain power in those two very important cities. By the way, this is very relevant for everybody that is watching this webinar. This is going to be the first time since the foundation of the Republic that the major elections will have a second round. So this is important because before, whoever got 32% was the mayor, or 29%. I think that, Rich, correct me if I'm wrong, but somebody I think that won with 28% sometimes. So that makes absolutely no sense. So this time we have a second round. So that should make the coalition building type of exercise a more doable situation. So we'll see. My sense is that there's nothing better for a country than checks and balances. So hopefully the center right will be able to win the Medellin and the Bogota mayoral race, and then Colombia will look better from the standpoint of ratings and the value of assets going forward. Chile Constitution. Maria Rosa, I drank a bottle of whiskey right after the Chileans decided that the Constitution would not go, and I enjoyed every single bit of the drinks that I had because I think that was the best possible piece of news that Latin America has gotten in a very long time. That was a bad constitution, and the population in Chile showed a very mature type of behavior in saying this is not good. Let's go back to the drawing board and do it again. And that's exactly what's happening. So at some point, I have no idea how this whole thing is going to work. If the legislature is going to be part of it, if there's going to be a council of pundits, if there's going to be a whole other exercise. But what I will be able to tell you Maria Rosa, is that whatever comes out of this exercise now is not going to be something like what we saw on the prior one, but something much more centrist and written by people that understand what the hell they're talking about. So to me, this is a very positive issue. Also on the fact that Boric lost a lot of political power probably means that pension reform is going to be lighter, meaning that it's going to be less bad for the financial institutions of Chile. And that means that savings are probably going to survive and the private system is going to survive. And that's also very, very positive news. Finally, in Brazil, I would mention that the fiscal will continue to be the main discussion of Brazil going forward. When Ben and I and Rich were in DC some 2 months ago for the IMF, I remember that when I hosted the Central Bank of Brazil in our IMF event, the 60 people that went to the meeting only had one question, which was relevant for Campos Neto and his team, which is, when is Brazil going to cut rates? That was October of this year. And now the market has completely given up on the possibilities of Brazil cutting rates. Why? Because President President-elect Lula has been unable to send a message of increased responsibility on the fiscal front. And we have seen this before. If there's no fiscal responsibility, then the central bank will have to do the dirty work to try to bring inflation down, which is a shame. I'm still not giving up on the possibility that President Lula will decide to send a much more tranquil message on the fiscal front by nominating a very market credible Ministro of Hacienda. Hopefully that will happen. Who knows? It will happen in the next couple of days, weeks. Who knows? If that happens, then we have a much better scenario from the standpoint of interest rates and the possibility of the Central Bank of Brazil cutting rates, and that should help the currency, should help the economy, etc. But for the time being, I agree with most of what the market is pricing in right now, which is that no cuts. Unfortunately, even though inflation was collapsing, and that's why I mentioned that in these meetings that we had in Washington a couple of months ago, people were just betting that the Central Bank of Brazil will start cutting rates in March or in June. But again, it was a very nice conversation, very bullish conversation from the standpoint of markets, but unfortunately, we are not hearing that anymore. But let's see. Again, I'm an optimist. Hopefully, a good name will come up on this front, and I'll stop at that and pass it to you, Kelly, and to Rich. Thank you.
So I guess I'm up. Anyway, just one key difference that I had with Alberto before the Colombian elections. I always thought that Petro was going to win, and sure enough, he did win. So that said, just a kind of a general outlook on kind of the ratings front. I think for the first time in a long time, we're generally seeing stable outlooks across Latin America. And this even predates the pandemic. The pandemic was quite hard on Latin America. Latin America was starting on kind of a very fragile footing to begin with. Kind of growth prospects were continually lowered in terms of kind of potential growth outlook for every major country in Latin America. And then there were the fiscal problems in most major countries in Latin America too. You saw debt to GDP rising pretty continuously for most of the major countries in Latin America. And then the pandemic hit, and the governments responded, rightly or wrongly, with a tremendous amount of fiscal stimulus. So you saw very high fiscal deficits in most countries in Latin America, with maybe the exception of Mexico. And as a result, you saw pretty significant jumps in debt to GDP. And that led to kind of multiple downgrades in most of the major countries in Latin America. In the case of Colombia, 2-notch downgrade to below investment grade. We downgraded Mexico. Chile was downgraded. Peru was downgraded. So most of the major countries in Latin America were downgraded. The exceptions were the Dominican Republic, Uruguay, and Brazil, all of which had negative outlooks, but we have revised those outlooks to stable, and they did not get downgraded during the pandemic. That said, I think the global backdrop is quite negative. We are looking at a mild recession in the United States, obviously interest rates rising, to terminal rate of around 5%. That's going to be negative in general for financing conditions as well as growth. We have a recession in Europe, somewhat more severe recession than we're looking at for the United States, and we have China only rebounding modestly after with the COVID policy, the zero tolerance their zero COVID policy, and also the housing market, the property market, which is quite fragile, having fallen over 20% both in sales and housing starts. So that's good. This is all going to be a drag on global growth. And then I think, as Ben was saying, for Latin America, obviously the tightening of fiscal policy that we've seen in general, but also more importantly, the significant hikes and interest rates with real rates quite high in most major countries. We're going to see a slowdown in growth in Latin America, and I think it's important to say that the slowdown in growth is going to pressure the fiscal accounts, and I think that's one area where, again, most major countries in Latin America have a real vulnerability. And so despite the fact that we have stable outlooks, I think there are some risks there. And I think the most challenging country is probably still Colombia. You've had 2 years in a row, well, actually 3 years now of general government deficits approaching 7% of GDP. Clearly, that's not sustainable. We are expecting some fiscal consolidation in the case of Colombia, but there's a lot of hard work ahead, and a lot of uncertainties on fiscal policy. I think the same goes for Brazil. Alberto and Ben both mentioned, the incoming Lula administration. The one thing that Brazil's had is a fiscal anchor, and I think that's being called into question with Lula indicating he wants a waiver from the spending cap, 2% of GDP. It's a very large amount, and I think that's created a lot of uncertainty on fiscal policy, not just for the first year of the administration, but for the entire administration. What is going to be the new anchor, if any? And I think that's part of the reason, like Alberto was saying, there's been a rethink in terms of whether the central bank in Brazil is going to be able to start cutting rates. 13.75%, extremely high rates. Inflation at 6.5%. I mean, so real rates are very high. But is the central bank going to be able to cut, given the fiscal fragilities? And I think that's a big question mark going ahead. And I think Alberto's right. Who is going to be the new Minister of Finance is going to be a key indicator of where policy is going in the case of Brazil. Something that we saw both in Chile and in Colombia was obviously when the leftist governments came in power, they chose very well-respected economists known to the markets, as ministers of finance. And I think that helped calm the markets in some ways, and also gave more credibility, at least on the fiscal front. And we've seen it in Chile, probably the only country in the world that I can think of that's actually running a fiscal surplus these days is Chile. We're looking at almost a 2% of GDP fiscal surplus in the case of Chile. And I think that's a really big anchor for the rating. Despite the fact that we have a recession in Chile, we have very large current account deficit, surprisingly large current account deficit in Chile. But I think that the anchor on the fiscal policy is helping maintain Chile's outlook and Chile's rating. In the case of Mexico, I think we're looking at a slowdown growth, but not that bad compared to the rest of Latin America. 1.5% growth. Again, we've had AMLO, at least in terms of macro policies, has been quite prudent. The only country in the world, or one of the only countries, not to run a huge counter-cyclical fiscal stimulus during the pandemic, been quite prudent, and therefore debt to GDP has not risen. It's been more or less actually stable throughout the pandemic, and so for a very good starting point. I think the question mark there in Mexico has always been on the micro policies, what they're doing in terms of energy reform, in terms of Pemex and such. And I think that's where the policies have been, his policies have undermined the growth prospects more generally. And I guess, politics again, the one country that we do have a negative outlook now is on Peru. I think the story there is, historically speaking, the politics and the economics were kind of disassociated. They didn't really, one did not impact the other, despite all the volatility that we're seeing on the political side. I think that has broken. I think, now we're seeing, the kind of dysfunctional politics with, how many ministers have there been in the last 2 years in Peru? This call for impeachment of the president that just keeps on bubbling up every other week, investigations swirling around the president. I think finally that we're starting to see kind of public investment has been impacted pretty negatively, but also private investment has been impacted negatively, and even in the mining sector, which is obviously key for Peru. So we're seeing, lower growth, but not just in next year, given the global context, but also probably in the medium term as well. Growth prospects more in the order of like around 2%, which in the case of Peru is very, very low. And conceivably, this can also lead to some kind of fiscal slippage. And even though the debt to GDP is relatively low, we could start to see that unwind basically. And I think that's the negative outlook for Peru's rating. And then very briefly on Ecuador, I think one thing that we've seen in Ecuador, the protests that we saw in the summer, I think that was a breaking point for kind of the outlook for Ecuador. I think before the protest, I think the growth outlook was actually looking better. The fiscal outlook was looking somewhat better. The idea that they could follow the IMF program was looking pretty good. And then the social protests hit, and I think that's caused a lot of turbulence. Not just access to the markets in general, but also called in question their ability to kind of toe the line on the fiscal side. So so it's kind of a murky picture right now. We have a stable outlook, but the rating's relatively low at B. So I think I'll leave it at that and to question and answers.
Okay, we have a few questions that have come in, but I did want to remind everyone that if you do have a question, please submit it in the Q&A tab and we'll be happy to refer it to the panel. The first question, I think, are you concerned about the external financing needs of Latin America at a time when interest rates are high? Or will the region be able to ride out this period of high rates and return to the international markets in 2023 without the risk of defaults to meet their financing needs?
And you wanna
question for you.
You wanna start with that, Ben? And I'll
I can take it, and then I think all of us probably have a thought to share on this. So I think if we think about external financing needs, I think we need to start obviously thinking about who's got the largest current account deficits, and those have been Chile and Colombia. And as was mentioned, Chile's current account deficit has been exceptionally high. Now, Chile is obviously on a different path, which is leading to uncertainty and to some degree has impacted its borrowing costs. Chile has also had gone through some shocks to its own pension system, which is to some degree diminished the capacity that very important local source of institutional savings to finance deficits. If we're thinking about, you know, how Chile finances, it's not just its fiscal, but if we think about the savings investment equation for Chile. Colombia has had a structurally higher current account deficit. It was unable to lower that deficit despite having very favorable oil prices. Some of that is the uncertainty in the sector that Alberto alluded to, and the fact that we haven't seen output really react to the better price environment. But I think it's also a question really just of how strong domestic demand has been in both of these countries, you know, with stimulus, both monetary fiscal, but also you know, on the Chilean side, disposable income augmented by the pension disbursements. Now, if these two, you know, have seen strong recoveries, very, you know, overheated domestic demand, the flip side of that is large current account deficits, we think Chile is in a better position to correct that, and is also in a better position, at least in terms of starting point, if we think about its sovereign balance sheet and still ability, you know, very low credit spreads, despite having some adjustment from what was, you know, even very, very low before. We're less, and also basic resources that the government can bring to bear. So that alongside our view that Chile is going to be going into a pretty sharp recession, which we've actually already seen in the, you know, the last quarter, whereas in the rest of the region, we're kind of waiting for that to happen. Should lead to a correction on the external side, leaving us less worried. It's really Colombia where we would be more worried about external financing needs going forward, given the idea that if, you know, the equation in terms of financing that very large current account deficit does depend on market confidence, both ability to have external investors continue to put money in the country, whether it be fixed investment or portfolio investment, but also that domestic agents are not trying to flee. So there, the equation I think is more tenuous. You know, Colombia has shown mixed signals. It's certainly, you know, by sticking to, you know, sticking to its fiscal rule, by, you know, the independence of the central bank, even though we've been rattled even there in the last week with the unexpected ouster of one of the key hawkish members. You know, all that said, Colombia has sort of bent but not broken up to this point. So I mean, and even, you know, speaking about ability to access external financing, they were in the market just this week, issuing external debt at a different level of price than what it had done in the past, a level of price in terms of the coupon on that bond, which would make us worried about debt dynamics, particularly in the type of slowdown we're seeing is going to be necessary in Colombia to correct that external imbalance. So, you know, there I think we're a little bit more concerned going forward. Ecuador is obviously one where lack of market access has now kind of become structural because of the, you know, unfortunate falling off of the path that Richard mentioned before. But overall, I'd say, but you know, to give a very, very general, you know, response and then wrap up because I know we're short on time. The low growth in the region, you know, the fact that we're coming from a level from low growth before the pandemic, the better tone in terms of commodities prices generally means that the region is not overextended. Although, you know, the two I mentioned are kind of the exceptions, but doesn't mean that the region is not really overextended in terms of large current account deficit, and not really overextended in terms of you know, overheated growth to the point where we're so worried about sudden stops. So I think we can kind of project, you know, tendencies where we can be worried about the medium-term trajectory, but a little bit less in terms of that we can have, you know, strong balance of payments crisis in most of the countries that we're looking at. So with that, I would sort of give a general view to offset the sort of the two countries, which I think are a little bit more worth watching in this space, which is given the large current account deficits of Chile and Colombia.
We just add that the region does need. We need some luck. We need the US CPI to start giving us a little bit of hope that we are in the process of gradual but material disinflation, which will allow the Fed to be a little bit more comfortable with the future, and therefore not continue front-loading policy the way that it has been front-loading policy. Because I agree with Ben 100%. I mean, yeah, yesterday's issue of Colombia, it was oversubscribed. The book was 4 times, I believe it was. But you were offering 8.5. So the last time you did a 10-year in Colombia, I believe it was 3.5. So this is a pretty massive increase in the yield that you were offering to try to get some people to participate. And if you do the comparison of how high this rate was from the standpoint of Colombia, and you go back 1.5 years and assume that Colombia is closer to Mexico, then probably Colombia would have only have to issue at 6.5 to get that money. But unfortunately, because of the very conflicting and simply completely unexplainable comments that are coming out of the Petro administration on the hydrocarbons front, I do think that the market penalized Colombia by charging the country much more. Hopefully, I mean, I know for a fact that Minister Ocampo understands this. I know that for a fact that the public credit director fully understands this, because that they talk to investors all the time. But hopefully, this will fit this news and this very high rate will filter into the cabinet as a whole, so that the country takes a much more centrist view in terms of forthcoming policy and avoid a crisis. Because if things don't go well, and 2024 comes up, Colombia is going to be out of the markets, and the only option is going to be to go to the IMF and get a standby agreement. So that's not nice. Whenever you have to go to the IMF, that's because you're in trouble. So hopefully they will get the message and don't make that mistake. So I'll just end with that. I agree 100% with Ben. I'm concerned about Colombia. The rest look much more manageable. I mean, Argentina, it's on its own. It will depend on whether or not the upcoming administration decides to do the right thing and fix the problem. If they do, this is a great story. If they don't, they're going to be a perennial underperformer, as this country has been for quite a while already.
Maybe just a couple thoughts. You know, you mentioned the two countries with the large current account deficits, which is Chile and Colombia, which means we have to pay attention to those and see what's happening. I do think Chile is going to recession. Colombia, we have growth slowing pretty tremendously from almost 8% this year to, you know, somewhere around 1.5% next year. Ben saying that they're calling for a recession. So I think a lot of this current account deficit will unwind as imports fall, and also the currencies are doing part of the job too. You know, both countries have a floating exchange rate, and you've seen depreciations, you know, some volatility, but overall depreciations, which should help as well. And then I think Alberto's right. You know, the policy in Colombia in terms of kind of the uncertainty on the oil sector specifically. You know, a lot of the FDI, which finances part of that current account deficit, has come from just that sector. So I think it's important for the administration to kind of, you know, really come out and define what its policies are. You know, ideally more positive for the sector overall. You know, Colombia has a great potential offshore. You know, supposedly they're making big fines offshore. And if they don't use that would be pretty sad, you know, both from the external and from the fiscal point of view. One other thought is, you know, the countries with kind of shallow local markets and that depend on external financing. Obviously, external financing conditions have tightened along with the Fed policy rate. You know, and those countries would be Ecuador, which Ben mentioned, which is, you know, kind of out of the market and you know, is really going to depend on multilaterals. Then you have Panama, you have Dominican Republic, you have Paraguay, for example, and those are countries which, you know, are gonna have to go to the markets, and you know, they're gonna, you know, obviously there's gonna be a price, and it's gonna be more difficult given the external conditions.
Thank you, Richard. This has been fascinating. Thank you all so much for your views. I think we're all leaving today a whole lot more educated than we were when we started. So I thank you for that. And I'll turn it over to Maria Rosa.
Thank you very much. Time flies when you are listening to such an intelligent and expert panel. Thank you so much, Ben and Alberto, Richard, and Kelly. You have made a wonderful, wonderful panel. And before closing, just a quick thanks to the wonderful staff of the association, Alexandra Vaquerizo, Laurie Dominguez, and Linda Calvet. And one upcoming event that you don't want to miss is the organized by the Ecuadorian American Association. We will host a webinar with Julio Prado, the Minister of Production, Foreign Trade, Investment, and Fisheries. Stay tuned for further information. It will be on the 12th. Thank you very much, and I wish you a very happy season. Thank you so much for connecting.
Happy holidays.
Thank you so
very
much for
much.
participating.
Thank you.
Thank you.
Wow, thanks.
Bye-bye.
Muchas, muchas gracias.